My parents were from Manila. They were brought up from a very, very poor background. I was born in Australia. As I grew up, they embed that it's important to always remember your roots. One of the things I've always wanted to do was to give back. Australia is my country, but my heritage is the Philippines. And I'm an accountant, and I'm here in Makati, Philippines. On the invoices section, you can see the overdue. We're here to try and promote online accounting to accountants and bookkeepers in the Philippines. I know there are plenty of accountants out there and limited numbers of jobs. Have you done this before, Joker? Who we're training up, introducing them to QuickBooks Online so that they can have the opportunity to work with international clients, Australian clients, US clients, and be able to grow further than they can from just being here in the Philippines. I've seen firsthand how accountants and bookkeepers here have it very tough.
You are doing 2017, but then again, your invoices are...
We have someone with us who, because I've taken him on, he can pay for his kids' schooling, and then it'll pay for half of their year's electricity and rent. Helping people here, it has a huge impact within our business.
Should we have a look at some work?
QuickBooks Online has been a huge game changer for us. Being able to utilise cloud software, being able to work anywhere in the country or even in the world, it has helped me believe that I could actually create this business. Without that, I would have stuck in that traditional accounting firm, worked the daily grind. I don't think I would have been able to start a new age accounting firm that is profitable and innovative.
Oh, hey!
We could do it all at home, but if I can give jobs in Australia and give jobs here, then it just makes my life more fulfilling.
Good morning, everyone. I'd like to add my thanks and appreciation for you being here today, for your support of Intuit all this year. And we're going to start out with what might be the last victory lap on FY17 results. I think it's always good to start out with what we told you last year and tell you how we did against these metrics, and that's what is presented here. And we're definitely not going to miss that opportunity when the results are as good as they were last year. Even better than this, we ended 2017 with customer counts well ahead of what we expected, especially in small business, which gives us a great tailwind and momentum going into 2018. Now, results like this don't happen automatically or they don't happen by chance. Brad reviewed with you some things that have changed this year from our mission to our metrics. I want to talk about a couple of things that are not changed, that are very much part of our DNA here at Intuit, that undergird all of our results that we deliver and the type of metrics you're going to see going forward. The first is to talk about our True North framework. And there are three parts of this that are fundamental to the decisions we make inside the company, big and small. And these are not charts on the wall. These are things we talk about in all of our meetings, and we really do drive to meet these objectives. First and foremost, we're always reminded that we have four stakeholders that we're solving for, and decisions have to be good for all four stakeholders: employees, customers, partners, and shareholders. The second part of this that's so critical to us is that we force ourselves to think of alternatives that solve short and long. We don't take a year off from delivering our results. We want to be sure that we're delivering against our guidance and against your expectations in the current period, but also making good decisions that are building a great company and providing strong performance for many years into the future. The third component of this that's so critical to us is that we use a standard of measure called best we can be results. And what this means is that we gauge our results not by some absolute level, but by and against the very best competitor or the very best alternative that our customers would see or that they would face. So it's a very relative target, but it keeps our focus on not just hitting a number or hitting a set of results, but by being the very best we can be and the very best that's available in the marketplace. So this is our True North framework. The other component that you've heard me talk about much before, and it's critical to the way we run the business and think about our planning, is our financial principles. And these haven't changed. They do remain very enduring, but I want to assure you that we challenge these and we discuss these every year as we go through our planning cycle, and we have a good debate internally as to whether or not they're still relevant or whether we should change them. On this first one, I got to tell you that we are more encouraged than ever that we can grow the business at the very top line through delivering customer benefit, through solving and delivering more money with no work with a very high degree of confidence. You've heard us say many times that we think customer growth is key. You've heard a number of different examples today. If we can get a customer in and demonstrate that we're driving that benefit, we can drive monetization over time where they're more than willing to pay once they're in and using the product and they're experiencing the benefits that we deliver. The evidence is clear to us. We're more confident of that than ever before, that customers and customer growth should be the way we drive our top line revenue. We'll talk about margins more in a minute, but for now, you should know that the idea, the discipline of growing our revenue faster than our expenses is deeply ingrained in our company across all of our management teams. It's something we talk about consistently. And so one of the beautiful things about having a company this size with these different portfolios, we have the opportunity to change allocations and move things around. We have the opportunity to think about things like new markets for QBO and things like that that might not be profitable initially. And that's why we talk about lifetime value to customer acquisition costs, to be sure we're investing prudently in those areas. But at the total company level, overall, long term, we think it's a critical element of discipline to be sure that our revenue grows faster than our operating expenses, that we're delivering operating income leverage. Now, we are trying to solve for the short term and the long. So we put a rigorous set of investment principles against internal investments, some you've heard mentioned here today, like infrastructure, marketing, things like that, or external investments. If we make acquisitions to accelerate our skills in areas like security or a different market like Brazil, we're looking for a 15% internal rate of return over a 5-year period. And we apply that really across the board for all of our investment alternatives. And we think it's important for the growth of the business long term to continue looking for those investment opportunities that are going to deliver this year, next year, and the year after that. The fourth principle really speaks to our stewardship to you all as to what do we do with the capital that we generate, the capital that we earn. Our share repurchase program, our cash dividend are critical elements, critical tools that we use to return cash to shareholders. And we think that's a critical part of our critical principle for us that's not going to change. Finally, we consider a conservative investment-grade balance sheet critical to sustain the business through all types of economic cycles and to take advantage of opportunities that may come along as they go along. So we are reaffirming, recommitting to these financial principles, and these are the ways that we think about and guide our long-term financial planning. Okay, back to revenue growth and how are we going to drive revenue growth at double-digit levels going forward. I'm just going to review with you quickly some of what you've heard in prior presentations about the customer growth opportunity in front of us. Left-hand side of this chart here, you see just a review of the addressable market and our penetration into those markets in the small business arena. And as you can see, even a small movement, even a small category shift into our products drives a huge unit increase component for us. So we're excited, we're encouraged about our ability to drive deeper penetration into all of these markets. The U.S. still has tons of opportunity left, as well as our other markets around the globe. So big opportunities there. On the right-hand side, I've graphed here for you the growth in our total small business paying customers back to 2014. This includes QuickBooks Online, desktop subscribers, and desktop unit sales. So it's the total paying customers in each year. You'll notice the last couple of years, we've had 23%, 30% growth in those categories, up from single digits a couple of years before that, which tells us that the desktop base is sustainable and also that we're having rapid growth and getting new customers into QBO. We're not migrating, we're not simply cannibalizing our own existing base. We are getting deeper penetration and paying customers into the addressable market. For the next few years, we think this total paying customer growth number ought to be in this same 20 to 30% range, as you can see by the slope of the chart. On the consumer side, Dan talked with you about this, and we still think there's plenty of game in the do-it-yourself market. We're committed to winning in do-it-yourself, even with free customers, and there's really good plans in place to do that. But we're excited now about some additional revenue pools as we move more to those customers, 100 million customers typically, who have a question or who want some assistance. As we think there's some unique ways that we can deliver that assistance and those answers, that help digitally that we haven't been able to do before, at a very convenient and a very reasonable price point for the customer. And so we're excited about that. I think there's plenty of game left in the consumer tax business to grow customers. This kind of shows you, and I'm going to show you a couple of charts here that really speak to the predictability of our revenue stream going forward. This says that over the next few years, we'll be north of 60%. 63% of our revenue will come from online offerings and TurboTax Online. Clearly, QuickBooks Online is driving a lot of that growth. The other thing I'd ask you to notice from this, though, is that we think our desktop business is going to remain a critical component of our revenue growth for years into the future. And this is a very profitable business. And this is one of the things that enables us to invest in new products and new markets and have the flexibility to balance off there and still drive good current year performance, but also make big inroads going forward. This is a chart Brad referred to earlier. And we just think about our current customer base today. 80% of the revenue that we have in our plan for 2018 will come from customers who are on board today or customers who have a very predictable rate of return. This is particularly true in the tax arena. So as you can see in consumer tax, TurboTax, 73% of the revenue we have in our plan for this FY18 will come from returning customers with a very predictable rate. 85% in QuickBooks and 90% in our Pro Connect area, where customers that are already with us today, already subscribers, or that return at very predictable rates. 80% of the revenue in the plan for FY18 is sort of already baked, we think, highly predictable, reliable. Okay, this is our annual update on average revenue per customer. I'm delighted to tell you that the trends over 2017 played out very much as we predicted and as we talked about last year. As we drive customer growth quite quickly, revenue per customer in small business is likely to decline, and you saw that in 2017, but frankly, a little less than we might have expected. QuickBooks outside the U.S., revenue per customer performed better than we had in our plan for 2017. And we talked about some of the improvements we made there in retention, some of the improvements made with accountant relationships, drove a little higher ARPC in 2017 than we would have thought about this time last year. QuickBooks Self-Employed, ARPC was down a little bit more than we expected last year. This is all a factor of the inclusion of the TurboTax bundle, which was at a lower price point. But again, those 170,000 units were all new to Intuit and new to the QuickBooks Self-Employed platform. And so we're delighted to have them. Lucas reminds us all the time that we'd be better off with millions more customers at a lower price point than the ones we have today, and that's certainly coming true here. The chevron in the middle is QuickBooks Online Worldwide. This is the overall number. It's 333 for 2017 versus 350 last year. This is a number that we hope and we expect is going to continue to drift down as we add a lot more units. Remember, we talked about at our earnings release and our guidance for 2017-18 that we expect QuickBooks Online subscribers to continue to grow for the next few years, north of 40%, but our online ecosystem revenue will grow probably a little more than 30%. So we do expect there to be continued some lag effect between the time we add new customers and we get them monetized at a full level. QuickBooks Desktop is up nicely in terms of revenue per customer. I will tell you, most of this is a result of the mix change with more customers, a higher percentage of desktop customers being in our enterprise solution, a very popular, well-used offering still today. As we lose more desktop customers on the lower end or people convert to QBO, QuickBooks Desktop Enterprise becomes a bigger function of the mix, and we think that's going to drive ARPC for the desktop business up going forward. Dan's covered consumer tax already in the sense that most of the increase in price per unit here came as a result of losing some free business or our free units being less than we expected in 2017. But there are also some interesting levers here that he's reviewed with you also about how we can tap into some different revenue pools going forward in the assisted category and providing some additional support there. So we think some slight increase in revenue per customer on the consumer tax side is reasonable over the long term too, and that's baked into our plans. Okay, that's a quick summary of how we make the money. Here's where what we're going to do with it and how we're going to spend it. This speaks to our margin. I know there's been a lot of questions about this and some have been written about our margin performance. You should just know that it's still our expectation that operating income over this long-term horizon ought to grow faster than revenue. We're committed to that, and that's definitely going to happen. But we're excited and we're encouraged by some opportunities we see to accelerate customer growth and accelerate our top-line revenue growth. And we're taking advantage of those in the plan for 2018. You heard Lucas talk about some improved efficiencies and effectiveness in our sales and marketing model. We're investing to change some of our care model from a very call center heavy approach today where a lot of customers have to call in to a customer care approach that is much more self-service, much more embedded into the product, and done with a lighter touch. Tayloe talked about investing in modernizing our tech stack and platforms, both in small business and in tax. That's going to drive greater productivity and effectiveness in our R&D spend. And we know, and we're working hard on our G&A. We think G&A is probably a couple of points too high for a company our size. You should know that there is a concerted effort in place that's been in place now for a few months to come up with some tangible improvements in that and drive that down a couple of points. The idea is to free up money that we can invest in machine learning and a couple of other areas I'll share with you in a second. A couple of other points here. I think revenue and margins by business unit are becoming less and less relevant as we go forward. As you can tell from Lucas and from Tayloe, more of our spend now is centralized. It's done more at the one Intuit level and shared by our business units. We think that's a great opportunity for us to get more growth and more profitability. We'll still talk about and still disclose those margin components by business unit, but they're going to be less relevant. The way we're measuring profitability at the company level is by growth in the operating income dollars. And we think it's critical. We've talked about this before, and as you can see here, our intent is to keep our operating income levels growing in the mid-teens. Our rough rule of thumb is that operating income ought to grow a point or two faster than our revenue. Our EPS ought to grow a point or two faster than that as we exercise our share repurchase program. So those are the long-term frameworks that are very much still valid, still much in place, and still very much in use by us. A couple of other housekeeping points here on this slide. We have revised our fact sheet and going back with historical data to reflect the organizational changes we announced back in August and also to reflect some new ways we're reporting our metrics going forward. That revised fact sheet with all the historical data will be available on our website later this week. Just a click down on where we're investing going forward. You've heard some of this already, but just to give you some, to kind of size it for you, our goal for 2018 is to allocate roughly 10% of our internal spend against 4 big initiatives. Accelerating our progress with artificial intelligence and machine learning is one. Enhancing our sales and marketing and our go-to-market position around the world is a second big initiative. Driving more productivity in our developer community, or enabling more productivity, I should say. Enabling them to get more things out to market faster is a third. That includes getting to AWS faster, as Tayloe just talked about. And then finally, accelerating our decision-making and making speed and getting to market quicker across the company a much bigger initiative for us. As Brad talked about during the year when we were revising our strategic plan, changing our mission, things like that, we came away from those meetings committed that we wanted to put real money and real investment behind these areas so that we could make really tangible progress and not work on them part-time or not just try to put a few dollars there and kind of limp along with it. So significant reallocations have already been made in the 2018 plan for this year, and we're going to continue to look at those as we go out throughout the year. Some real positive trends here in free cash flow as our capital expenditures continue to trend down and continue to come down. We instituted our cash dividend in 2012, and it's grown at a compound annual growth rate of 18% since then. We've signaled a 15% growth is what we expect for 2018 in the cash dividend. Share repurchase is a critical tool that we use to return capital we can invest profitably in the business back to you all, and that's going to remain a critical component for us. We signaled last year a return to more normalized levels of free cash flow return to investors. And frankly, some people missed it, and it resulted in some share counts that were higher than we came in, higher than we delivered. So we tried to be a little more purposeful about that this year in our guidance and some of the direction that we gave around our share repurchase program this year. But the one thing that's not changed, one thing you can count on from this, is that we will continue to return a significant portion of the capital we generate each year to our shareholders. Talking about share repurchase, there's nothing new on this page, but I just give you a little more insight into how we think about this and how we manage the program. We have some maximums and minimums here. To determine the maximum, clearly it has to be cash in excess of what we think we need to run the business and to make prudent acquisitions in the course of our investment and accelerating the business. We use our 3-year financial plan. Brad talked earlier about the commitment we have with the board and to each other internally for a 3-year set of results, not just 1 year. So we have that to go with. We do not assume any multiple expansion as we go through this. And so it's just basically what we think it's going to do. And clearly we have to earn at least our weighted average cost of capital on any shares that we repurchase. On the other side, on the minimum, we clearly expect to offset stock-based compensation. And we typically do that, our policy says, over a 3-year basis. The last few years we've done even more than that in each given year. But at a minimum, that's one of the ways we think about a guardrail for that. This is the guidance that we released back in August. No big change here. We're certainly delighted with the 10% revenue growth last year and to be able to guide 9 to 11% for 2018 is a big deal for us. We've talked a lot about investing to drive this growth. It won't be a surprise to you that a lot of the investment it comes in the form of people, in adding people. Over the last recent months, and actually the last couple of years, stock-based compensation has been the largest component of our operating expense, and it's the part that grows the fastest, I should say. And so that's caused our GAAP operating income guidance for 2018 to seem a little out of sync, out of consistent with our financial principles. I want you to be aware that we are very focused on that internally, and we think that's a big issue that we need to find ways to moderate, and we're working on that aggressively. And we're confident that we can do that while still attracting and hiring the world's best talent. We think this is a short-term thing, but many of the skill sets and much of the talent we need, especially in this geography, is much in demand and it is in short supply. So that's caused some pressure with our stock-based compensation expense recently, but we're working through that and we have some plans to moderate and mitigate that going forward. So, in summary, we're totally excited about the business for 2018. We think we have a good plan, an aggressive plan, and solid execution things to deliver against it. We also think this plan delivers really good long-term growth. We're building and investing in a great company long-term. We're going to be diligent with our financial principles, and we look forward to reviewing our results with you during the year as we move forward. Thank you.